welcome to the deep dive.
Yeah.
It's really quite something how deeply information technology has woven itself into pretty much every corner of our lives.
It's everywhere.
Think about it, right?
Yeah.
From connecting with family halfway across the world to managing our entire financial lives, it's all happening through technology.
Absolutely. Invisible lines of code, like you said.
But what happens when that financial life, the one running on these complex systems, needs a really rigorous check for accuracy, for integrity?
That's the crucial question, isn't it?
So today we're taking a deep exploration into a topic that, might sound a bit technical up front, but it's just so vital for trust in our digital economy.
Yeah.
We're talking about auditing in a computer-based environment.
Right. Essential stuff.
Our mission really is to unpack two key pillars.
Yeah.
Application controls and these things called computer-assisted audit techniques, or CAATs.
The digital guardians, you could say.
Exactly. The guardians ensuring financial accuracy in this, increasingly digital world. And we're drawing our insights today from a really thorough article on this exact subject. It lays out the key things auditors need to think about when systems are basically run by technology.
It's a solid source, yeah.
So let's maybe start right at the beginning. Why has IT become such a game changer for auditors, especially when we're talking financial statements?
Well, it's fundamental now. IT isn't just like a helper anymore. It's the actual backbone of modern accounting and management information systems too.
So it's not just an add-on.
Not at all, because almost every transaction, every ledger entry, it flows through digital channels. So auditors simply must have a really deep understanding of IT's impact. It's not optional anymore. It's foundational knowledge.
Okay.
And this impact, it really shows up in two main ways for you as the listener to think about. First, how a client actually uses IT, to gather, process, report their financial information. That's their system.
Right.
And second, how the auditor themselves can use IT as a powerful tool, really, in the process of auditing those financial statements.
So it affects both sides.
Exactly. It's a dual transformation. Change the whole audit landscape.
That makes perfect sense. I mean, if all the data lives inside these digital systems, then the systems themselves become part of the audit evidence, part of the scope.
Precisely.
So if we think about a company's own internal safeguards, you called them digital guardrails earlier. What exactly are these application controls?
Okay, application controls. They're essentially the specific checks, both manual and computerized, built right into a particular software application, within that computer-based accounting system.
And what's their main job?
Their core objectives are pretty straightforward. Ensure completeness, accuracy, and validity. For every single entry that goes into the accounting records, think of them like ongoing quality assurance checks, running constantly inside the software.
Okay.
And an effective system, especially in a computer environment, it's got to have these controls at every key stage. When data goes in, input. During processing. When reports come out, output. And critically, over the master files, the standing data.
Input, processing, output, master files.
Got it. And I guess the auditor needs to really understand these checks inside and out to figure out where the potential weak spots are.
Exactly right. The auditor's job involves ascertaining what controls exist, recording them, and then meticulously evaluating them.
To assess the risk.
Yes, that's how they determine the risk of material misstatement in the client's financials. If those controls are weak or maybe not operating effectively, then the risk of errors or even fraud goes up significantly.
Okay, let's unpack that first stage then. Input controls. This is where the data first hits the system. What's their main purpose and what are some common examples? The ones that catch errors right at the front door.
Right, input controls. They're specifically designed activities to ensure that all data being entered is properly authorized, complete, accurate, and timely.
Okay.
A really common example you probably see every day is just an on-screen prompt, like when a system asks you to log in. That's a basic authorization control, right? Preventing just anyone from entering data.
They also enable the creation of an audit trail. That's crucial for letting you trace a transaction from its very first entry all the way through the system to where it ends up. Traceability.
But the real sort of power comes from automated validation checks. We can talk about a few key types.
Yeah, let's do that.
Okay, so format checks. These are simple but effective, like making sure you put numbers in a date field, not letters. Just checking the information is in the correct form.
Makes sense.
Then you have range checks. These ensure the input is reasonable. Imagine a company, maybe they rarely make a single purchase over, say, $500.
Okay.
A system with a range check might automatically flag or maybe even reject a purchase invoice that comes in over $50,000 because it's way outside the expected range. It forces a review.
That's smart. Catches potential big mistakes or maybe fraud right away. What else?
Absolutely. Then we have validity checks. These make sure the data input is actually valid in the context. For example, if you tried to book costs to a project code that the system knows is already marked as completed, a validity check would reject it, right? Because it doesn't make sense anymore.
Exactly. And compatibility checks. They ensure data from two different fields actually works together logically. Like making sure a sales invoice total value is compatible with the amount of sales tax charged on it prevents mismatches.
Okay. Lots of different angles.
Yeah. And there's more. Exception checks automatically produce reports for unusual situations. Things like highlighting a negative inventory quantity, which shouldn't happen. Sequence checks reject documents processed out of order. Really important for things like pre-numbered goods received notes. Helps ensure none are missing, completeness.
Right.
And finally, control totals. These are really vital for ensuring batches of data are fully entered. You might manually add up a batch of, say, purchase invoices before input. Then you compare that manual total to the system calculated after input. If they don't match, bam, it flags an error immediately. Something's missing or entered wrong. And one more. Actually, checked digit verification. This uses clever algorithms on things like supplier codes or account numbers to catch input errors almost instantly. If you mistype a digit, the checked digit won't calculate correctly, and the system rejects it.
It really is like having a very meticulous digital bouncer at the door, isn't it? Making sure only good, clean data gets passed.
That's a great analogy. Yeah, that's the goal of input controls.
So once the data makes it past the bouncer, what about the controls during the actual processing of that data? Inside the club, so to speak.
Right. Processing controls, their job is to ensure all that good data, the stuff that got in, is handled correctly, and that the data files, like ledgers, are updated properly, accurately, and on time.
Two examples.
A key one here is what we call run-to-run controls. These are all about ensuring the integrity of cumulative totals that get carried forward. Think about your bank balance on a statement, how it carries forward month to month. Run-to-run controls make sure those kinds of balances, like maybe a control account balance in the general ledger, remain consistent and accurate from one processing cycle or run to the next.
I see. Keeps the running totals correct.
Exactly. And these controls also govern how systems manage any data that was rejected back at the input stage. It's not enough to just reject it.
What needs to happen then?
Well, there should be things like computer-generated printouts of rejected items. Formal written instructions for staff on how to investigate and follow up on them. And, crucially, clear evidence that any errors found have been properly corrected and successfully re-input into the system.
So you close the loop.
You have to close the loop. Otherwise, errors could just fall through the cracks and never get fixed.
Okay, so data's been input. It's been processed correctly. Now it needs to be reported or shown somehow. How do companies control the output, make sure it's right and goes to the right people?
Good question. Output controls are there to ensure, 1, that all the processed data is accurately presented in reports or on screen, and 2, that this output is distributed only to the specific authorized users who are meant to see it.
Makes sense. Security and accuracy.
Precisely. Common controls here often include things like continuing to use those batch control totals we talked about, but now comparing them to the output reports to verify completeness.
Okay.
There's also the really essential review and follow-up of any exception reports generated during processing, making sure any unusual items flagged are actually investigated and resolved.
Right. Don't just print the report and ignore it.
Exactly.
Okay.
Other critical controls involve careful scheduling, making sure information gets distributed in a timely manner, having formal written instructions for how distribution should happen, and ongoing monitoring, usually by a responsible manager, to ensure output is only going where it's supposed to go.
You really don't want sensitive financial reports ending up in the wrong email inbox or left on a printer.
Absolutely not. Control over distribution is key.
And finally, you mentioned master files earlier. That core sort of static data, like customer lists or product prices, what controls protect those? Because an error there could spread everywhere, couldn't it?
Oh, definitely. Master file controls are designed specifically to ensure the ongoing integrity of that standing data. This is the foundational information. Customer names and addresses, product codes and prices, employee pay rates, chart of accounts, stuff that doesn't change with every single transaction but is used constantly.
The bedrock data.
Exactly. And it's vitally important that really stringent security controls are applied to all master files. Because, like you said, a corruption or an unauthorized change here could have a massive ripple effect throughout the entire system's calculations and reports.
So what kind of controls are we talking about?
Well, things like the appropriate use of strong passwords and access controls to restrict who can even view or change master file data. Establishing really adequate procedures for making amendments. This includes proper authorization for changes and, crucially, segregation of duties. The person requesting a change shouldn't be the same person approving it or implementing it, ideally.
Okay. Prevents unauthorized changes.
Yes. Also, regular independent checking of master file data. Comparing it back to authorized source documents like contracts or price lists just to make sure it's still accurate.
Periodic verification.
Right. And applying processing controls over the actual updating process for master files, too. Things like using record counts before and after an update, or control totals on key fields to make sure the update ran correctly.
Yeah.
These layers of defense are absolutely critical because, as you said, master data is the bedrock.
Wow. It sounds like an incredibly robust, multi-layered defense system a company really needs to build and maintain within its IT.
It really is, when it's done well.
So, okay. We've talked a lot about the internal checks and balances within a company's systems, these application controls. But for an auditor coming in, simply knowing those controls exist isn't enough, right? They need to actually test them.
That's exactly right. Understanding the design is step one. Testing if they actually work as intended is step two.
And that's where their own digital toolkit comes into play. How do auditors leverage technology themselves to carry out their procedures when they're auditing these complex systems?
This is where we get into CAATs computer-assisted audit techniques, and they really are powerful. CAATs basically involve auditors using computers, either the client's machine or often their own laptops with specialized software, as an audit tool.
Okay.
And what's fundamentally transformative here, I think, is that these aren't just, fancy gadgets. They allow auditors to go way beyond just testing small samples of transactions.
So they can look at more data.
Potentially all the data in many cases, analyzing entire populations of transactions, which, as you can imagine, significantly enhances the reliability and the depth of the audit evidence they gather.
That sounds like a huge leap from traditional manual methods.
It really is. Now, the decision to actually use CAATs instead of manual techniques, it depends on a few things.
Like what?
Well, practicality is one. Is it even feasible to test manually? Cost effectiveness is another. Available audit time, access to the client's computer facility. Also, the auditor's own experience and expertise with CAATs matters.
Sure.
And sometimes it depends on how much the client's internal audit team uses CAATs and whether the external auditor feels they can place some reliance on that internal work.
Okay. So broadly, what kinds of CAATs are there? You mentioned two types earlier.
Yeah, generally they fall into two main categories: audit software and test data.
Right. Let's start with audit software. What exactly is that, and what does it let an auditor do?
Okay, audit software is really a generic term. It covers computer programs that auditors use to perform tests of controls or substantive procedures. Those are the direct tests on the actual numbers in the financial statements. And the software can be broken down a bit further. For instance, you have packaged programs. These are like off-the-shelf, generalized audit software, not specific to any one client.
What would they do?
Oh, lots of things. Selecting statistical samples, performing arithmetic calculations across huge data sets like re-adding entire ledgers, checking for gaps in sequences of invoices or checks, identifying duplicates, stratifying data.
Yeah.
Really useful general purpose tools.
Okay. Powerful workhorses.
Definitely. Then you have purpose-written programs. These are usually custom-built, maybe by the audit firm or specialist, for a specific client or a specific complex task. Maybe reperforming a really complex computerized control procedure the client has, like their unique cost of sales calculation, or doing a detailed aged analysis of trade receivables for a company with, hundreds of thousands of customers, something almost impossible to do manually or with just generic software.
Tailor-made for the job.
Exactly. And third, there are inquiry programs. These are interesting because they're often programs that are already part of the client's own accounting system, but the auditor can adapt or use them for audit purposes.
How does that work?
Well, for example, if client's system routinely produces a report listing all employees who started or left during the year, the auditor can use that existing system report as part of their audit procedures for salaries and wages. They're leveraging the client's system capabilities.
That's clever. Using what's already there. So audit software lets you analyze and test the client's data. What about test data? How does an auditor use that? Is it like crash testing the system?
Sort of, yeah. Audit test data is used specifically to test the existence and the effectiveness of those application controls we talked about earlier, the ones built into the client software.
Yeah.
What happens is the auditor creates a set of dummy transactions. Some transactions might be valid, designed to be accepted by the controls. Others will be deliberately invalid, maybe with incorrect codes, amounts outside limits, missing data, that sort of thing.
Yeah.
Then these dummy transactions are processed through the client's actual computerized system. The auditor knows beforehand exactly how the system should react to each dummy transaction based on the control supposedly in place. They compare the actual results what the system did to their expected outcomes.
I see. So if they put in a payment over the limit, it should get rejected.
Precisely. For example, they might process 2 dummy bank payments, one within authorized parameters, one clearly outside them. They'd expect the system to accept the valid one and reject the invalid one, perhaps listing it on an exception report.
And if it doesn't? If it accepts the bad one?
Well, then the auditor knows that specific control isn't working as intended. They can't rely on it. And they'd likely need to increase their other audit procedures, their substantive testing in that area to compensate for the control weakness.
Okay, that makes sense. But this brings up a pretty critical question, I think. How do auditors actually run this test data through a live client system without messing up the client's real data? That seems risky.
That is a very important point and a major consideration. Processing dummy test data directly within the live client environment does carry a risk of corrupting the client's actual data, which would be, as you said earlier, a nightmare.
Yeah.
Now, auditors could try to arrange special processing runs using copies of the client's programs where only the test data is processed. But the drawback there is it doesn't give you complete assurance that the test data is being processed in exactly the same way as the client's live data is during normal operations.
Right, it's not quite the real deal.
Not quite. So to really address this, auditors might seek the client's permission to use something called an integrated test facility, or ITF.
Okay, what's that?
An ITF involves setting up a kind of dummy unit. It could be a fictitious department, a dummy customer account, a dummy supplier, maybe even a dummy employee right within the client's live accounting system.
Inside the live system, really?
Yes, carefully segregated, of course. This dummy unit allows the auditor's test data transactions to be processed during the client's normal routine processing runs alongside all the client's actual live data.
Wow.
The beauty of this is it provides much, much greater assurance that the test data is being subjected to the exact same processing and controls as the client's live data. It's a real-world test. And procedures are put in place to carefully remove or reverse the effects of the test transactions afterwards so they don't permanently distort the client's records.
That is a brilliant solution. Real-world testing without, hopefully, breaking anything.
Exactly. It takes careful planning and cooperation with the client, but it's a powerful technique for testing controls in a live environment.
Okay, so we have audit software for analysis, test data, and ITFs for control testing. Are there any other major techniques auditors might use, maybe things embedded in the system itself?
Yes, there are a couple more worth mentioning. One is embedded audit facilities, or EAFs.
Embedded?
Yeah, this technique actually involves embedding small modules of the auditor's own program code directly into the client's application software.
Whoa! How does that work?
It allows certain verification procedures to be carried out automatically and concurrently as the client's data is being processed in real time.
Like what kind of procedures?
Well, for example, auditors might use an EAF to tag certain transactions that meet specific criteria, say, all sales over a certain value. The embedded code then tracks these tagged transactions as they flow through the system, recording which controls were applied to them.
So you could see the control working or not working in real time on real transactions.
Essentially, yes. Or another type of EAF might be an analytical review program embedded in the system. It could perform comparisons or ratio analysis on client data as it's being processed, flagging anomalies. The results of these embedded tests are usually recorded in a special secure audit file that only the auditor can access later.
Very sophisticated, continuous monitoring almost.
It leans in that direction, yes. Another related technique is application program examination. This isn't about testing transactions, but about testing the program itself. Auditors might use specialized software tools to compare different versions of a client's application program code, say, before and after the client made system amendments.
Why would they do that?
To ensure that the changes were implemented correctly, that the controls documented are actually the controls present in the code, and importantly, that no unauthorized changes were made or that the changes didn't inadvertently weaken other controls. It gives assurance about the integrity of the system's evolution.
Maintaining control over the system changes themselves. Makes sense.
It's crucial, especially as systems are constantly being updated.
Okay. This has been a really comprehensive look at both the controls within systems and the tools auditors use. If we sort of try to connect this all back to the bigger picture, well, what's the main takeaway?
Well, I think it's really vital to remember that the core objectives of an audit, they don't actually change. Whether you're auditing a manual system with paper ledgers or a highly complex, fully computerized environment.
Right. The goal is always the same. Provide an independent opinion on whether the financial statements are true and fair. Assure their accuracy and reliability.
Precisely. That fundamental objective remains constant. But, and this is the key takeaway, the audit approach, the things you need to consider during planning, and crucially, the specific techniques you use to gather enough appropriate audit evidence. Those change profoundly with the shift to a computer-based environment.
So the what stays the same, but the how is radically different.
That sums it up perfectly. The auditor's toolbox, their methodology, even their skill set has had to evolve dramatically just to keep pace with the technology clients are using.
Which definitely leads to a fascinating final thought, doesn't it? As we look ahead, this raises an important question for all of us, I think. How might the continuous rapid evolution of things like AI, machine learning, advanced automation, how might those technologies further transform these auditing techniques we've discussed, maybe even in the very near future?
That's the million-dollar question, isn't it?
Could it push the boundaries even further? What becomes possible then for ensuring financial integrity? Will audits become even more real-time, perhaps? Maybe even predictive?
The potential is certainly there. It's an area of huge interest and development right now.
It really is a fascinating thought to consider as technology just keeps accelerating. Well, thank you so much for joining us on this exploration into the digital world of auditing.
My pleasure.
We really hope you, the listener, found it as insightful and hopefully as interesting as we did.